Okay, so thanks for joining us, Zach. This is another episode of Real Insurance Made Simple, and we have Zach Mefferd here with Zip Bonds. I actually first heard of you, Zach, when I was listening to the Agency Freedom podcast,
Mm.
actually. And I did not know a whole lot about bonds, but I knew that my clients needed them and the
Yeah,
service that you provide and the way you operate with them. I was like, this is my go-to right here. So that's
awesome.
kind of a little bit about how I found you and how I started doing that. I did open this office in November of 2022 from previously working for another private agency. So it's
Oh,
been a whirlwind, best decision I ever made. But in a nutshell, that's kind of who we are and the partnership and why our partnership started with you guys. I would love for you to tell the audience what you do, how Zip Bonds came about, and we'll jump into it.
all right. Well, hey, thanks, Beth, for having me. Glad you found us. I did not realize you had started an agency in 22. So now, right off the bat, we have two things in common. One, I was at one point a person that was completely oblivious to anything surety related, and I was frustrated with that process and didn't know that's really the genesis of Zip. And two, I was a commercial insurance producer turned scratch agency owner. I worked for a company. I was top producer for just over 3 years, and then started a scratch agency in 2016. And when I say scratch, I mean no network, no cluster, no anything. It was literally,
Same,
yep. I
same.
had one. So I started my insurance career at State Farm, and I jokingly said like I'm a captive right now when I started because it took a while to get the ball rolling. So I can completely relate to anything that you're going through, and if later we get into it, I can also commiserate with some of the things I'm sure that you're struggling with. But yeah, I mean, that's the high level, how I got into this, right? So I stumbled in insurance like everyone does. Really thankful that I did. I still think the insurance industry is one of those industries that's massively overlooked and misunderstood. And I think there's a perception out there that's, not obviously accurate for what most of us know. But I stumbled into it and then figured out I was pretty good at it, and I liked it.
Hmm.
But the former part of that story is before I moved and needed a job, I actually had started a business. So when I tell my story to anybody, I always like to point out the fact like I'm an entrepreneur first. And I just happened to stumble into insurance, which allowed me to, and that was somewhat intentional, but allowed me to be an entrepreneur through insurance. And so started as a commercial producer, started a scratch agency, and got really the whole idea behind the agency was one, I wanted to be an entrepreneur, work for myself. And I also was very intrigued by the fragmented tech stack in the space at the time. I mean, there's still lots of fragmentation in the PNC world, but this will make sense when I get to how Zip came about. The whole reason I want to make the jump is because there were a lot of things that just didn't make sense to me, and I don't know if it's my OCD or what, but I wanted to fix that part of it, but I had to figure out a way to generate the cash flow to do it. And so when we started our agency in scratch, we really just were selling everything we could to keep the lights on. In fact, one of the guys, I guess you could call him, he wasn't like an official mentor, but he had said, look, you're going to spend the first couple of years selling anything you can, just keep the lights on. And then you'll spend the next couple of years getting rid of all the stuff you shouldn't have written the first couple of years, right? And that was very much us, but we were fortunate enough to attach ourselves to an affinity. It was a credit union, fourth largest in Iowa. They
Very
took a liking
nice.
to what we were doing. And the agency that we had started, they were referring a lot of business to us. And so we said, hey, we noticed that you don't have an insurance division. Why is that? Which started the conversation of, well, we want to, but we don't know how to get into it. And we've looked at buying books and we don't have someone that can run it, blah, blah, blah. And so we pitched them idea of like, we'll start an agency from scratch for you and help
Hmm.
you build up a book of business and manage it for you. But we want you to invest in some of the things that we're doing here on the technology side because we think we can do this significantly more efficiently if we just put a couple things in place and made some connections that at the time didn't exist.
Hmm.
And so that was our whole journey. That we kicked that off in 2020, literally 45 days before COVID was, a thing and kind of shut down everybody.
What
And
timing?
yeah, and so we had started going down that journey, and as I like to tell, I had more time than I would have liked. Even though I was busy, I wasn't as busy as I'd like to be. My wife likes to point out that you can't just stop putting more stuff on your plate. And like, he's like, you don't know how to relax. And that's probably fairly true. But
Entrepreneurial spirit
right,
there. Yeah.
right. But as a commercial insurance producer, that's when I was first introduced to surety. And I remember the feeling I had of the one of the direct carriers that we had access to, not wanting to take the time to help me understand what I didn't understand and
Mm-hmm.
didn't have the patience for it. And at the time, his exact comment was that I needed to call a competitor down the road and partner with them to have them do this for me because, it wasn't basically worth his time to do it. And I just was really frustrated with surety. And that's going back to 2013. That was my first, like, it kind of stuck in the back of my mind. And as I transitioned from being a producer to a scratch agency owner, trying to write everything, surety came up every now and then. And I had largely a book of contractor clients because that's just
Mm-hmm.
I guess I'd say the niche I stumbled into and I related well with. And so I started, getting larger and larger at bats. And what I found is that there were a lot of agencies that I'd compete against, especially the larger ones that would already have like a benefits division and a surety division. And so when I would pitch PNC, which I was fully capable of doing well, to these prospects, I found that I had to solve those problems for them too. And I could always find someone to be my benefits, person that could, I could run quarterback, but they would take care of it for me. I could never find somebody that would do surety in a way that made sense and it was at the standards that I had set for, the client experience for my clients. And so, that again, just kind of it's just kept building. And then in 2020, when I had more time than I'd like, it just coincidentally right before COVID, we had been talking to a few carriers about this tech platform we're putting together for the insurance side. And I remember walking into one of the carrier partners that we happened to stop by to talk to that was surety only. And I saw the technology they were using on a
Mm-hmm.
day-to-day basis. And like this light bulb went off in the back of my head. And I was like, I knew how fragmented surety was from PNC, even
Mm-hmm.
at the carrier level. I think it's fragmented. It's like the surety people are off in the corner. But and I could see firsthand the client experience from like, us being as agents being the clients of the carriers, the UX being antiquated and just not really dynamic. And I could see that. But then when I saw the other side, I was like, oh, okay, this is definitely an opportunity that, the reason why it probably doesn't exist is no one's really trying to fix the problem from the PNC side out. They might be forcing technology on it, but I don't think anyone's really addressing, you know, the technology disconnect from the seat of a insurance producer or CSR.
Mm-hmm. Yeah.
And so that's the genesis of the dip. I started putting together a business plan and I didn't know if it was going to go anywhere. We actually, at first, that carrier I was specifically mentioning, we presented it to them and said, here's what we would do if we were you, because that's what they asked for. And, these are the things that we think need to change because the reason they invited us there, they said, hey, we heard you guys are big into technology and want to do it. We just want to get your opinion on some things. So initially, Zip wasn't called Zip. We pitched them this idea and we gave it to them. We said, just here's what you should do. We'd be happy to be an agency that beta tests this for you.
Oh,
We'll be on a
wow.
committee, whatever.
Mm-hmm.
And they didn't do anything with it. And so that just like really built up. And I had way too much time on my hands during 2020. And I got the pitch together. And I asked a couple other agents and pitched them and said, Shark Tank me, what you think? And it was like the further I went down the rabbit hole of all these different things, the more confirmation I got that this is something that's needed. And even
Mm-hmm.
though at the time I was not, and I still don't claim to be a surety expert, I could see that there was, I knew I could connect the dots if I had the right opportunity. So we raised a little bit of money in 2021 and started this with two goals in mind. One is I wanted to solve the problem I had as an agent. I
Mm-hmm.
wanted to be able to provide that surety solution. We say all the time, the best agencies we work with see us as their surety division. We're like just
Yes.
back in the corner. We do the bonds for them. We help them. We take something off their desk, make it easy, and then help them look really good to their clients. And the second thing, which I think we've done exponentially well, is we have solved a lot of the issues that I saw on the technology side, both from our agent portal and the options that we have there, but also the core system that we built out. We built it as if we were the carrier, and there's been just so many efficiencies that we can create in how quickly we can conduct business
Mm-hmm.
by having a streamlined process and technology that supports ultimately what we're trying to do. And so that's for the last 4 years what we've been building up, and we're a month away from 4 years in.
Well, I can tell you my experience, it hasn't been a whole lot. Like I don't do bonds every day, but every time I've had one approach my desk, I email you guys, and I think I work with someone in your office. She's phenomenal. Um, I'm gonna get her name
Yeah,
wrong.
but Havila.
There you go. Yeah,
Yeah. A
Havila.
lot of people say I have a little bit Havila. Yeah, Havila or Tyler would probably be the ones you would be talking to. Yep.
So she emails me back almost
Oh,
immediately. Here's the bond. If they want it, here's the link to pay for it. It is the most seamless transaction that I think I do on a daily basis. It is, I love it. But people are coming to me as their agent, and then they're saying, well, this person's fully insured and bonded. And I'm like, well, that doesn't make sense because I'm pretty sure bonds are
yeah.
job specific. So why do they have that on their business card? Or they'll
Right.
say, I want, they're new. And they'll say, I
Yeah.
want to be fully insured and bonded. I'm like, well, do you have a job that you need to be bonded for? Well, no,
Right.
but so and so has it on their card. So
Yeah.
that's why I really felt like this conversation was important.
Yeah.
Because the series I'm putting together is a business series more geared toward the client to try to
Mhm.
just for it to be
Yeah.
informational, let them learn because insurance is so transactional in the sense that hey, give me a price, I'll give you your payment. I have insurance and I'm just covered for everything.
Right.
And that's not how it works. We are
Yep.
very an educational office. Let's sit down, let's review, let's look at your risk. Do you want to pay for this coverage or don't you? If you take this
Right.
off, even though you're going to have a lower premium, you're not going to be covered. So we're really focused on education as a whole. And I feel like bonds is that market that just no one understands, but
Right.
it's all these people are required to do it. So
Yeah.
go ahead.
No, I said, yeah, I agree.
Yep. So, with that being said, from working in the bond market, do you see a particular industry or any type of perceptions that come with it that you would like to just knock off like right
Yeah.
away?
Well, let's squash the first thing that you said, right? A client comes in and says, I want to be fully insured. Okay. Well, what does that mean, right?
Right?
We're in the risk management game, and like you said, it's about creating options and letting people decide what level of risk they want to transfer to a carrier versus take on themselves. And so
Hmm.
fully insured has always made me laugh, and that's why I was smiling when you said that because it's like, what does that mean? Even a small mom and pop shop, like, do you have cyber coverage? Do you have a formal board? Do you have D&O coverage? Do you have there's so many other things that are ancillary that they don't even think about. They just think like, do I have liability coverage? Do I have auto coverage? Do I have work comp? Like
Yep.
that's fully insured. So I think the misconception or misperception, whichever you want to say, about being fully insured, I think that's very easily relatable to how people see being fully bonded or being bonded. And so, I'll get into the industries in a second, but what I first want to clarify is anybody can be bonded, literally anyone. It doesn't
Hmm.
matter who it is. And in the most simplest way that people will be offering, and for any agents that are listening to this, if they want to have that conversation, I've always said the easiest way to get into surety, start asking your current book of business if they've ever needed a bond or if they want to know how they can be bonded.
Hmm.
And then they always bring that up in your renewal conversations as well as you're presenting, different options or just doing a review. So there are, we use contractors as an example because it's very simple. When they say they're fully licensed and bonded. So there are three different types. We categorize bonds in basically three different buckets. There's a commercial bond, there's contract bond, and then we have a miscellaneous, which I would say would fill the court, fidelity, things that aren't 100% black and white if they're commercial or contract bond. So I'll start with the commercial bond. If a contractor comes in and says we want to be fully bonded, they might just be saying that they want to have a business services bond, which is
Hmm.
essentially a bond that would cover them and their employees while they're doing work for their customers. And if something comes up missing, that bond would be a way of protecting the homeowner or business that they're working for if something was stolen. It's like some people call it a crime bond, and it's different than in the P&C world from crime insurance because not all crime insurance is going to cover. It's usually more like, hey, somebody embezzling money or somebody's taking money from
Right.
the company internally. This is more external. If you're a contractor like today, I had an electrician at my house. If I come home and I find that he was in my office and some of the collectibles that I have up on the wall are gone, and I claim that he did it, and pressure like that, that is a way of a business protecting themselves. They're like, I have a business services bond I'm
Hmm.
bonded up to a certain amount. Most people start about $10,000 of coverage, which is it's 1%, so it's $100, and they can say that they're bonded, and that helps some homeowners, at least those that are educated, like I'm protected if something goes missing, right? This is
Right.
very common for janitorial services, like a Molly Maids or something like that too, that would have a bond, some jewelry stolen, something like that. That's a business
Oh.
services bond. So you can have $100 bond and be bonded. To your point of being on the project specific, that is more of what I was initially focused on in starting zip bonds. That's
Hmm.
your contractor that wants to bid mostly public work. There are examples, and we're seeing more of them every day with these different sizes of projects and the uncertainty of tariffs and materials, where a private project could be bonded. But
Hmm.
essentially, like if your local city, town, state, county, whatever, wants to bid a project, they will typically put it out to bid, and the contract itself will require those contractors to have a security with their bid. And they can do it one of two ways. They can provide a cashier's check for a percentage of their bid. Usually it's 5, 10, or if it's federal, it could be a 20% amount of that of their bid. That essentially says, I checked my math, I know I'm good. If you accept my bid, I will accept the contract. We recommend not doing that because unfortunately, we've seen far too often where somebody puts down a cashier's check, most recently a large six-figure amount of money, that they didn't think through the process that if they won the job, they have to provide a bond, and they are not anywhere near being at a level where they should take on a project that size. And so some bond companies don't want to, do business with them.
Ooh.
So they're
Yeah.
really putting up some risk when they do that cashier's check. But I think, if a contractor is not educated on this, and goes back to like you saying, education. If you have contractor clients and you're talking to them, and if they're bidding work and they've always done it with a cashier's check, if they win that job and they can't get the bond, they're basically out that money unless they, decide to go to the second bidder, which happens. So it's risky, and you have to go through the process anyway. So we provide bid bonds free of charge, and the bid bond is basically a way of a third party underwriting this contractor. There's three C's: the character, capital, and character, capital, and capacity, to
Hmm.
make sure that that contractor isn't taking on a job that's too big for them, that they have the specialty that they need to be able to complete the contract, and that they aren't going to go bankrupt in the process. That's why these municipalities are requiring it, because they don't want someone to submit a bid. The guy finds out that he's 50% lower than the next person and says, well, I'm going to walk away from this job. No, you put that bid in, you secured it, you have to do it. So the bid bonds, like I said, we provide for free. And then once they win the contract, they'll have a performance payment and usually a maintenance bond. Performance being the bond is the contract's performed to the specs and that things are done the way that they should. Payment mostly tied to, if you have subcontractors, making sure they get paid. If you have suppliers, obviously you're gonna have suppliers that they get paid. And then a maintenance bond is essentially a warranty. It could be 1 year, 2 year. We see, here where I'm at, 4 years maintenance periods. And so I'm kind of getting back to your initial question here, like the different industries that you see. Almost anybody can get a bond. It's just the
Hmm.
type. Is it a commercial, simple license permit bond, or a business services bond, or is it, a contractor that's looking to bid public work? In that case, contractors are, I think, one of the best ones to go after, because those bonds they come with, there's more premium to them because there are higher amounts of bond penalties, and there's more underwriting and risk involved. So you see industries, it could really be anything, but contractors being the one that we focus on, the majority of what we do here.
Gotcha. And so just to kind of summarize what you said, that bond, whether it be the performance, the payment, or the maintenance, that's to protect essentially the local entity that is
Municipality.
hiring
Correct.
them.
Yep.
It doesn't protect necessarily the contractor who has to obtain the bond. It's them saying, "Hey, I'm showing you I have this bond, so you have protection and confidence in
Correct.
knowing I'm going to do my job."
Yeah, and it protects them from it's especially if it's a new project. Let's say your city's building a new public library. Well, if the general contractor wins the bid, performs the contract beautifully, but then doesn't pay the supplier or doesn't pay the
Hmm.
subcontractors, now they're going to file a lien against that property. And so what this surety bond does is it essentially acts as a third party. That's one of the biggest difference between insurance and surety, which we can get into in a second. But
Hmm.
they're protecting the municipality and ultimately the taxpayers from them
Hmm.
having to pay out the money that should have been paid from the general contractor to these suppliers and to these subcontractors.
Got it. Got it. So go ahead, and you said we can get into that in a little bit.
Yeah.
Go ahead and jump into what you were going to say or
So
elaborate on.
I think the biggest misconception, and it's because surety is regulated by the insurance industry, and that's
Mm-hmm.
why insurance agents typically sell it. However, if you look at the underwriting characteristics of a surety bond, it's more underwritten like a financial product. So in layman's terms, I like to explain to people, a surety bond's like a co-signer on a line of credit.
Oh
That's what
yeah.
they're doing. So there's three parties here that are involved. You have the principal, so your contractor, whoever is working on this project. You have the obligee, which is the municipality. Then you have the surety that acts as that cosigner that says, hey, Mr. and Mrs. Town hall representatives, if we've vetted XYZ contractor, we feel confident that they're going to be able to perform the job. They're in good standing. They pay their bills. They're not going to run out of money. But if they do, for whatever reason, something bad happens, we're going to act as that cosigner and take care of this. And typically, what that looks like is a surety would react and then find a contractor to complete the project and pay any
Mm,
difference in the amount of the original bid to the contractor that finishes it. The reason why it's different is you think of insurance, it's so that's a three-party system.
mm-hmm.
Insurance is just two-party, right? You're transferring the risk from the insured to the carrier.
Mm-hmm.
If a claim is paid out, well, that's what the carrier signed up for. They pay the claim, and yeah, the insured may see a higher rate increase or may get canceled, but they're not on the hook for anything. In a surety relationship being three-party, and using my financial analogy,
I
that
like that
cosigner,
analogy. Yeah.
they're still on the hook.
Mm-hmm.
So even if that surety has to react and pay for any overages or differences between the other contractor completing the work, the initial contractor that won the bid isn't off the hook. That surety is going to be able to go after them and be
Mm-hmm.
able to, try to be made whole. So insurance, Progressive has historically said that they shoot for 96 total combined every single year, right?
Mm-hmm.
4% is what they're making. And that's great if you're, doing billions of dollars, right? Like they are. In surety, and the direct loss ratio is what, maybe like 60, 70%, something. I'm probably way off, but again, I'm a little rusty on the P&C stuff now. But in surety, it's underwritten to a 0% loss ratio, just like a loan is. And so when the carriers are underwriting these, they're trying to make sure they're not going to have any losses. And if they are, they're very minimal. And that's the reason why, if you have a contractor that says, why does my wife have to sign for this?
Mm-hmm.
Why do I have to sign anything? It's like, just like if you're doing a loan, you and your spouse are going to sign for it. It's not a loan, obviously. So it's called a general indemnity agreement that you're agreeing that, yeah, I know I'm on the hook for this if something happens. And so surety in a nutshell, three-party process versus a two-party in insurance. You're
Mm-hmm.
not transferring the risk, they're more sharing and co-signing for you in that transaction.
I really love that scenario. It really helps you understand because in insurance, we understand that insurance is creating their premiums based on what they anticipate their risks to be.
Right.
They're anticipating some
Right.
risk, whereas you're saying like no bank wants you to default on the loan.
Right. Yep.
Just like it sounds like no bond or surety wants you to default on that or file that because they're also going to hold you accountable. They're not
Right.
just going to handle it and sweep it under the rug for you.
Yeah, that's
So,
exactly right. That's the why it's underwritten. So they're still underwriting it to an expected loss, but that loss is 0% as opposed to, a direct of, like I said, I don't know if
yeah.
it's 60 or 70 or a total combined of, 90 or below if they can get there. But yeah, that's the biggest difference.
Yeah. Okay. Well, that's really good. Thank you.
Hmm.
Um, I'm just kind of looking at my questions here. We kind of already hit on, do you see more professions? Do it over the
Yeah,
other?
I cheated a little bit. Thank you for providing me that. I probably gotten ahead a little bit because I want to make sure I covered everything you wanted to get through in this
No,
podcast. But
no,
that was
you,
nice to set that up.
yeah, absolutely. I like to give people an idea. So let me ask you this, school bus contractors.
Yeah.
I have a lot of them, they're like, I don't know why I gotta get this, but they're making me, they won a bid to drive the
Yep.
school bus for
Yep.
the school corporation. In our area, it's usually like 6 years.
Yep.
Can you elaborate on why that is important for them?
Yeah. So if the school district's planning their budget, right,
Mm-hmm.
and that budget's already set sometimes a year or so in advance, if the contractor, the independent contractor that has the school bus program wins that bid, and let's say they're 20% less than the next person,
Mm-hmm.
that school district's not going to want to have to be like, oh, I'm sorry you went bankrupt, or oh, I'm sorry things didn't work out. We're just
Mm-hmm.
going to be okay with adding an additional 20% to our budget that we've been planning out,
Mm-hmm.
and going on to the next one. Or worse yet, if they didn't require a bid process with a bid bond as part of it, a contractor might come in and just try to undercut everyone. And
Mm-hmm.
then if they undercut someone too much, they could just walk,
Mm-hmm.
and so that bid bond can have a claim on it. If
Mm-hmm.
somebody bids, let's just use simple math. Let's say the contract was won at $100,000 per year for 6 years.
Mm-hmm.
And then the next closest is 175,000 for
Mm-hmm.
that. That person who won it, there's no bid security there. They might say, "Oh, I messed something up. I shouldn't have done this," or, "Oh, it's not
Mm-hmm.
worth it to me. I'm just going to walk."
Yeah.
And that puts the school district in a bad spot. So I think, you know, um, I don't know enough about specifically what caused that, but my guess would be it was something like that. We were tired of people walking away because their bid was so much lower, or it was part of a process that we do with everything else that we do for the school district. So why wouldn't we have the school bus, the third party school bus transportation company bid this as well? School buses come up, I think, because there's a decent premium in there, and it's relatively prevalent in certain states. But I mean, this is no different than if they were doing the janitorial.
Mm-hmm.
Janitorials are going to require bids as well, and a lot of other services that are ongoing. I think it's just part of their process. But ultimately, I think the reason why they do that is because if that 20% difference happens in year three, the surety's going to come in, hire the other company. They're going to take over that 20% difference, so the school district doesn't have to take that on and add it to their budget. And then they're going to go after the third party independent contractor to be reimbursed for that. Now, the reality is, even though they try to get to a 0% loss ratio, if something like that were to occur, if everybody had the good intentions going into it, maybe there is a bankruptcy for a death or something like that. That surety's probably not going to have anything to go back after, but at least they have the option of trying, and
Mm-hmm.
that's why, even though they underwrite to zero, I've never seen a carrier that didn't have a carryover from a prior year just get everything right. That year,
Right.
there's still losses.
Sure. That makes sense. Perfect. So completely different direction. 401ks, I think they're called ERISA bonds.
Yeah. Yep.
Okay.
Yep. Response. So there's a federal requirement that you have protection in place to make sure you're not mismanaging the use of everyone's 401k. And so
Mm-hmm.
again, this is a way, it's a federal requirement, and they put this in place to make sure that, somebody can't say, well, I trust my buddy with our 401k to oversee it because, we golf together, and, but not really do any due diligence to make
Mm-hmm.
sure that they're doing it well. And again, I'm sure this was triggered by something very specific that I just am not aware of, but it's a requirement. Just like I'll use freight brokering as an example. This is a big thing in our industry right now. Anybody who's brokering freight, whether they're doing it internally or using a 3PL, a third party logistics company,
Mm-hmm.
there's a federal regulation if you're crossing state lines at certain weights that you have to have a $75,000 BMC 84 freight broker bond in
Mm-hmm.
place because it protects people that are booking. I saw this. I don't know why this came to mind, but I saw this reel because I don't have TikTok. I'm too old and I have too many distractions. But
It
they
all
they
works
bought
the same.
right, yeah. It's good enough for me to still have something to entertain myself. But a car dealer works with another car dealer across the country, and they want to get a car transported. I think in this case it was like LA to Atlanta, and they hire a company that neither one of them own or work for to trust that that car is going to get from one
Mm-hmm.
spot to another. If that doesn't go through well, or that car goes missing in the process, that's what they want to have to go back on. What we're
Gotcha.
seeing in the space right now, it's making it incredibly difficult to write these bonds. And I think this again makes my OCD of the tech side of there's so many solutions for this that I wish were in place that aren't. But what we're seeing is a company will sign up as a freight company.
Mm-hmm.
They will set up their LLC or whatever, and then they'll go out and they'll book freight from another company, and then they'll file a claim claiming that they did get paid. Well, what we're finding out as we kind of peel the onion, as I like to say, is that fraudulent freight brokering company is also a fraudulent company that is making the contract. And so they're abusing the system because they're filing fraudulent insurance claims to try to get up to that $75,000 requirement. And it was
Oh my
happening
goodness.
so much that almost every single market in the country is saying, we're not going to write these anymore because there needs to be a better process in place of verifying that these companies are legit. I feel bad for anybody that wants to get into freight right now that has the best of intentions and is actually a legitimate business owner because it can be really, really hard if it's their first year. Because one of the easiest ways to determine if they're actually legit, how many years have you been in business and what do your
Experience.
financials look like? Like, can we prove that you're actually doing what you claim you're doing? Because a lot of those claims came from, new freight brokers where the underwriting wasn't catching or anticipating that, they were going to have all these bad characters. And so, yeah,
Oh
so
wow.
again,
That
uh,
completely like total change of gears here, but
yeah,
working with another individual who wants a commercial auto policy for his own trucking business.
oh yeah,
It's not general freight, but one of the things, because I have family members who do
yep,
hauling, and one of the things that we have seen is before I was even in the insurance industry, my dad had a hot shot business and he got canceled for rapid growth. And it's because he was hiring these guys around
yeah,
and adding drivers. Well, now that I'm in the industry, come to find out they don't like rapid growth because these um, companies who are trucking, they essentially get bad DOT scores and a bad rep. So they put them on a new
yep,
business and just start
yep,
swapping them.
yep.
And I was like,
Started
ruining
DOT
it for
number.
everybody.
Yeah. Yeah, and again,
Oh,
it goes back to like my OCD. Like there needs to be a better way to verify this common
yeah.
ownership, and I think some of the things have gotten better, but even with the bid bonds, there's probably more fraud than we'll ever know of bad characters who are
Hmm.
providing bid bonds to contractors, collecting payment and never telling the surety because nobody ever checks. Does it have a
Ugh,
signature? Does it have the crimp? Can I feel it?
yeah.
That's not, thankfully not all of them do the actual physical crimp with the seal and they move to electronic seals. But I mean, to me, it's like we were on a proof of concept about using blockchain as a way of creating keys on both sides that could verify in real time that this was actually an executed surety bond.
Hmm.
So I think of solutions like that, that if the infrastructure were put in place, could eliminate a lot of this because it would be so much harder. Now, could they still do fraud some way, shape, or form? I'm
There's
sure
always someone who puts more effort
is going to
into
find it,
that.
right?
Yeah.
But I mean, I think it would be such a simple way of verifying that everybody's on the same page and everybody's agreed to it and that it is legit. But when you're relying on paper and a signature, these fancy looking forms, it's not hard to forge things if you really wanted to do it. And I kind of fault a lot of the municipalities for not doing a better job of just verifying,
Hmm.
and I love when they do because it's like, thank you. That due diligence needs to exist in your process to make sure that this is
Yep.
here to prevent this. Because it's a legitimate concern for the surety industry.
Yeah. No, those are very valid points. And it shows the real life of it all. Like
Yeah,
like when people come to us, it's not as easy of, oh, I just need a bond. Well, you have to meet this criteria. You have to prove all of
yeah,
that. And even that, sometimes that's not even foolproof.
yeah.
So,
That's a good point, and that's probably something else we should bring up. So, when we talk about the types of bonds that we offer, we jokingly say we do all bonds except for bail bonds. And believe me, when we
really.
first started, I don't know why, but we had a bunch of bail bond calls. We don't do that. But we have just over 7,000 different bond options that we provide to agents on their branded hyperlink that they can go in and immediately start marketing these. A new agent that signs up with us will have a branded hyperlink ready to go in, 15 minutes. And it's branded to your
Hmm.
agency logo, colors. I think you have one that's set up it's like that. But of
I do.
those, yeah, just of those over 7,000, roughly 3,500, just over, are what we call select pay print. So those ones, there's essentially it's this direct pass-through. There's no underwriting. You can just go on and buy it. An example would be, let's say your town requires you to have a license and permit bond if you're a contractor doing business in your city. That bond is typically 5, 10, 15, sometimes up to $25,000 before underwriting is required.
Hmm.
And so if you just want to hop on the website, fill out your information, drop your credit card or ACH, you can print that bond off and you're ready to go. There's
Hmm.
not a whole lot of stuff there. And so when you talk about like you need underwriting though, on the flip side, if you're a contractor looking to bid public work, there is a process, just like if you were getting a loan and that's why certain other information is required. Now, thankfully, we're able to, with very little information, it's mostly a credit-based application process. If the contractor's been in business for a while, at least a year, we can pre-approve them, or I'm sorry, pre-qualify them up to $1 million, just like
Hmm.
as fast as they can type that information in. But if you get over that amount, the carrier is going to do their job and they're going to make sure, your financials are in order, that you're not, losing a bunch of money, that you are well capitalized, that you're not going to put yourself in a position where, you have a claim and
Hmm.
or, you make sure that they're in good faith able to provide those bid bonds. It's a vetting process. What I think is wild is, when people come in and they're so confused, I say come in, but, I mean, email or call and the largest project maybe they've ever completed is $100,000, but they want to go bid something that's 5 million. And I'm saying, that's like walking into a bank and asking for a loan on $1 million house when you have a $40,000 a year job. Like it's just,
Hmm.
sometimes it just doesn't work. And in that situation, I like to think that we're helping people protect themselves from themselves and
Yeah.
helping them see that. But we also try to educate them as to, okay, if you want to get there, great. Here are the steps you need to take to be able to get to that point because we want you to get there just as fast as you do, but it's not going to happen overnight. We need to stair step this a little bit, and then we help work with agents and agents that want us to with their clients to help them put a plan in place so they can ultimately get where they want to go.
Oh, I love that. I love that because again, that's how I operate. I work with a lot of new ventures, and I'm like, you don't have to start out insuring for X, Y, and Z. You need to protect your assets,
Yep,
you know? But as your assets grow, you can't keep paying for this just $1 million CSL. You got to grow with it.
gotta go.
But also, they have no clue. A lot of times people walk in, they have no clue what they even need. And
Right.
so all of, when you're working with someone who owns their own business, they clearly have usually something in them to want to grow and be entrepreneurial and
Right.
all of those things. So to be able to provide clients the steps to get to that $5 million job is always the end goal. Or with the 10, sky's the limit, right?
Yeah.
So
Well, I
I
mean,
love that you guys will do that.
and again, I mean, if I'm being honest, it's self-serving, right? Like if someone's stair stepping, growing their business, and they're doing larger and larger projects, everybody wins. The contractor
Mm-hmm.
wins, the agents that work with us win, we win. I
Mm-hmm.
mean, it's in our best interest to do that, much like when you're educating your clients on things, you're
Mm-hmm.
helping protect them so they don't lose what they've had and you want to see them grow because
Absolutely.
again, they need more and that's just how it works. And I don't know. I guess it goes back to the probably that feeling I had back in 2013 when I felt like this big
Mm-hmm.
when that surety underwriter was making me feel dumb for not understanding something that, I was relatively new to. I just that's why I think I take more time in preaching that in our office and telling like we need to help them understand that. It's not, yes, it makes perfect sense to you, but you do this every day and it doesn't to them.
Mm-hmm.
I used to explain it to me like I'm five, like help me
Yeah.
understand and how to get there. And then it goes to like one of our pillars. You have four core pillars here, like how we operate, but it's really like, genuinely care and genuinely help that agent and that client
Mm-hmm.
get to where they need to go and do it as if you were doing it for, a family member or a friend.
Right.
You know?
Yes, absolutely. I love that. So one of the scenarios we recently had, you mentioned that most bonds that are job specific are for public,
Mhm.
but you're seeing more private. Um,
Yeah.
we had, I guess it would be like a developer. He's doing some townhomes
Yeah.
for private, right? Not for
Mhm.
public. Um, he was potentially going to have to do a storm drain,
Yep.
but
Subdivision bond.
yeah, yep. And we were going through that
Yep.
process, but now there might be some deregulation coming for our state. And I don't know if I told you we're in Indiana. Um,
Yeah.
Potential that they're waiting on to be signed. So they're like, do we actually even need a storm drain
Yes,
or don't
do we not
we?
need some? Yeah.
So
Yeah.
what are you guys kind of seeing as far as like public policy and regulations? How is that impacting your bond market?
Yeah. That's a really good question. Subdivision bonds aside, the day-to-day stuff really right now is focused around what the surety industry this year I saw slightly higher than average direct loss ratios. And when we, like I always say, peel the onion. It's one of my things around here is, why did that happen? Well, you see some of the contracts that ended up defaulting. A lot of those contracts weren't signed in, 2024, 2023. They were signed in 2020 or 2021 with
Mm,
the understanding that, it was going to be business as usual. And in uncertainty of supply chain issues and cost of materials and just the ability to have a strong labor force has thrown a monkey wrench into some of these plans and what
Hmm.
they've seen. So I think, when you talk about regulation right now, I think what's on the contractor's mind specifically that we talk to is what does this look like in, 2 years, 3 years, the new administration in place, making all these drastic changes right out of the gate. Is that something that's impacting my business? I nobody's ever said this directly, but I know there's some, that are concerned about, their labor force and what they've had, am I going to be able to have that? I'm going to be able to complete these projects.
Hmm.
And I think even though not all the products that come in, or materials, I should say, there's still going to be an impact of some of the raw materials that we're getting from other countries and these tariffs that are
Hmm.
coming in. So I wouldn't say though right now that there's a large amount of concern. In fact, most of the contractors I talk to are saying like this is one of our best starts to the year that we've had, and
Mm.
we've seen that. But I think in the back of their mind, and a few of them have told me this directly, is like, they saw kind of a yo-yo effect when everybody had money and things were going well, and the money was prevalent in 2020. It was great. You
Hmm.
couldn't phones ringing off the hook, and then it almost like had this hangover effect. At the end of 21 into 22, and so those that have been in business that long, I think they're trying to think ahead of how to prepare for that,
Mm.
and just make sure they're not, getting too far ahead of their skis, if you will,
Yeah.
on what they're doing. But other than that, I mean, that subdivision one that you brought up, we don't run into a whole lot of that.
Hmm.
Subdivision bonds it's can be a little bit trickier. I actually think they're kind of fun to write. And those that are doing it, depending on how long it takes them to develop everything, one of the benefits to surety is if you have a contract bond, it's over when the contract's over. On a
Hmm.
subdivision, depending on how long it's there, it can last for a few years. So there is a renewal. I guess that's one of the other differences between surety and insurance. I think a reason why a lot of insurance agents don't chase most surety is because they don't perceive it as something that has a renewal, right? Like
Mm-hmm.
I'm not going to chase something because I have to start at zero at the next year. What I would encourage producers to think about when they're thinking through if they want to chase, especially contract surety, is we track this, and on average, we don't see a jump up or down more than 10% on these contract programs we put in place for contractors. So what I'm saying is, a contractor that's doing say 5 million
Hmm.
in business, with contracted projects in one year, they're not going to go likely not going to go before 4.5 and probably not going to go above 5.5. Like that's, I think I'm doing my math right there. But even though it's not guaranteed renewal like you would see with other insurance products, it's as close as you can get to it. I mean, we really don't see as much of a fluctuation as I think many may perceive is the
Right.
case.
Hmm.
But I don't know. That was something that came to mind because I think that's the reason why, outside of just not being able to do it all day, every day, and being a subject
Hmm.
matter expert, I think that may be one of the reasons, producers don't go after it.
I could see that because they're fairly affordable for most things. So if you have to
Mhm.
redo it every time, like even for an agency, like when they're affordable, even if it's a higher percentage rate on the commission, it's still fairly
It-
small in the grand scheme of things. But it really is a good way to round out the account to really truly help your client in the best capacity if you can factor that in
yeah.
rather just letting it run down the road somewhere else.
Well,
Um,
and I said like defense is the best offense.
mhm,
Is if that contractor needs bonds and you're not doing it, they're getting it somewhere. And
mhm,
that's that wedge that they're going to use to try to take that PNC away from you. So why would
exactly.
you want to play defense to make sure that you have that option?
Absolutely. So I kind of want to just recap in general what we've kind of heard today. There can be a general, like if someone wants to put fully insured and bonded, it's more of a crime, lack of a
Yeah,
better
a
word,
business services bond. Yep.
business services bond to where they are essentially saying, hey, homeowner, I'm bonded. So if that homeowner's educated, they know that if something's missing, they're bonded for that.
Yeah.
Whether they're a cleaning service or an electrician or a plumber, totally common for that.
Very,
And
very much so. And I just want to add one thing. I
mhm,
have plenty of businesses that come to us from agents that the owner is the operator. And they're like, why would I ever need this? I'm not going to ever take
mhm,
anything. I'm not worried about it. I don't need it. That's fine. You can choose to do that. To the fact that most homeowners aren't educated.
Hmm.
They just like hearing that you're bonded and insured,
Hmm.
and it's $100.
Peace of mind. Yeah.
Just they don't ask you for your coverage limits. How many homeowners even ask for a COI to make sure that the people on top of your roof replacing it are actually covered by a work comp policy?
They
You
just want
know,
to see the business card most of the time that says fully
that's all they
insured.
want to see.
Yeah.
So spend $100 and get it and feel good about it. But yeah, that is something you can easily provide, and that's for any business. It doesn't matter who it is, but I would say,
I mean, as an
contractors.
insurance agent, when I go and I go to someone's house and I'm taking photos, whatever, I could have a business service bond.
Yes, you
Yeah.
absolutely could. And again, this goes back to rounding out accounts and providing value. What ask for it? Yeah, it's only $100, but why not have that in there? That's one more thing. I'm probably misquoting this, but I remember it stuck with me. Travelers are saying, like we want to be with we want agents to have 4.5 policies per household because it has a 10% or higher retention rate.
Hmm.
And obviously you can't have 4.5. But my point is like it's basically saying five or more. If
Hmm.
if they have more policies with you and it's something that's that easy, why not have that one thing and all you have to do is ask.
Yeah.
We have the ability. It's like a an endorsement. Do you want to add this bond for $100 this year and make sure that you can tell everyone that you're licensed and bonded and
Yeah.
insured? Yep.
And it sounds like, based off what you said, those type of business service bonds are like what you called like a print to paper.
Yeah.
Like you just go on there, you submit that you want it, you pay for it, and you're done.
It's
There's not a lot of
literally
underwriting to it.
yep. Select pay print. That's what we call it. You select what bond you want, you pay for it, you print it off, you're done.
So aside from the business services bond that kind of act like a crime bond essentially for layman's terms, they are more job specific, typically with your local municipalities,
Mhm.
um, or sometimes private jobs. And it is job specific or regulation specific, kind of like the
Yep.
storm drain. And it's just, going back to the storm drain, it would be to make sure you perform the job, make sure you pay anybody who does it, and it sounds like the maintenance as well to make sure it holds up for 2 to 3 years to do what it's supposed to do.
Yeah, and it's also a promise that you're going to complete the project, right? So if you're
Yeah.
putting in a new subdivision and the municipality is putting in these utilities, you're
Hmm.
you're you're saying like, yeah, we're going to finish the project. We're not going to leave you with a mess and walk off this,
Mm.
project when we realize we could only sell two of the lots on this, new subdivision.
Mm. Okay, that's so it's not just for like a portion of it. So like and the reason I'm asking is because in the scenario I was in, they were requiring them to have it specifically for that storm drain because it
Yeah,
was going to be a
yeah,
private deal when it was done.
yeah. And to me, that sounds like it's more of a, hey, we want you to have this here and make sure that you're not installing something that's just going to fall apart and be garbage because we need the
Right.
water to drain out. There could be multiple different reasons for that, but essentially, yeah, it's to protect the investment of adding any of the utilities that are there and that you're not just going to walk away and you're also putting in stuff that's not just going to fall apart right away. So,
Exactly. And then the final piece is that it sounds like when it comes to these, you guys will also do the free bid bonds, which they could navigate through me to do, and I could do through you.
yes,
In the
absolutely.
event that they want to put in bids, like, hey, let's do a free bid bond first to make sure all that,
Yeah,
basically all of our I's are dotted and T's are crossed before you potentially get that bid, rather than doing it with a cashier's check, right?
yeah, exactly. So if they want to bid public work, like I said, we sometimes see private, mostly it's public work. If they want to be able to have the option of bidding that work,
Mm-hmm.
and to me, I just don't understand why some of these contractors don't at least want to have the ability to do that and
Mm-hmm.
wait to it. I think some of them, again, your perception is reality, right? And if their perception is that it's a really strenuous, frustrating,
Mm-hmm.
sharing way too much information type of process, but they only need a two, three, $400,000 bond a couple times a year. The reality really is that it isn't that hard. It's mostly something that small. It's credit based. But then once they figure out that maybe they can, start bidding some of these to supplement their other private jobs, then that can just grow. And then we've seen a lot of contractors do that where they say, I didn't realize it was going to be this easy to get it. They take a couple of small projects and they start realizing, okay, this is a really good, silo that we had added to our business that we can now have. And
Mm-hmm.
then as they get better at doing that and winning more jobs, and then again, we help them stair step that up to a point where they can essentially grow as big as they want.
Yeah, yeah. Okay, I think I summarized a good portion of our
Yeah,
conversation.
very much
If
so.
if you could leave one thing with the potential buyer or contractor on the bond space, what would you leave them with?
What do I leave them with? Well, I mean, other than making sure that you at least have the option of being able to bid by by
Hmm.
by at least pre-qualifying yourself to that, I think, you know, uh, one of the biggest things in getting and building that business something good is doing a really good job of just running your business and not, letting your business run you. And so what I mean by that is if you want to grow your business, you want to get to a larger, projects or just whether it's public or private, it's gonna be really important for you to be able to take care of the basics, the blocking and tackling of running a good business. One of the
Mhm.
most common things you run into with contractors are contractors who don't do a very good job of keeping their books.
Mhm.
It's a bunch of receipts in a shoebox and we take it to the bookkeeper once a year and we figure it out.
Yeah.
Something as simple as, $70 a month to have a QuickBook, accounting software. And there's other options out there too, so you don't have to go with that. And there's cheaper options. But just run your business as if you actually want to see what your margins are. I mean, not only is it good for surety and good for just, you eventually growing. And if you ever want
Mhm.
to get a loan to expand or do that, you're going to need to have that. So it's good for that. But also just as entrepreneur to entrepreneur, like it's a scoreboard. You want to be able to see where you're growing. You want to be able to find the red flags where things aren't going well and being able to address those before they become bigger issues. So I would say if
Yeah.
I'm giving any contractor advice, that would be the number one thing is, hire a good accountant or at least nothing else, at least keep good books and make sure you're reviewing that stuff so you know the health of your business. Because if you don't know your numbers, you don't know your business.
Yeah. You can't scale if you don't know what numbers you're working with.
That's right.
So, well, Zach, I appreciate you more than you know. I think this is a super beneficial conversation for the listeners, for myself. I think it's a topic that not a lot of people touch base on, but I do think it is important, especially I'm in rural Indiana, lots of small contractors all around me.
Yeah.
I mean, it's just what they do. It's how they all make their living.
Mm,
So, I appreciate your time so much, and I hope
yeah.
that we will continue to be in touch throughout the course. I do want to leave my listeners with that Zach and Zip Bonds is who I use and who I go to on a regular basis. I do see you guys as my like bond division. Someone comes at me, says, I need a bond, or what's the question about the bond? I know I can get the answers if I don't have them right away. So
Well, thank you, Beth. It was a pleasure. I enjoy doing this stuff very much so. So if something that comes up, you want to do it again, just let me know. You know where to find me.
awesome. Thank you so much, Zach. I appreciate your time.
You're welcome.
All right. Bye.